Fire.
Chris Bowling.
Brad Johnson.
Hey, Brad, thanks for joining us again. Bottom Line Thursday. We're here once again. You've got a good topic for us talking about healthcare bills. I think something that we all have experienced and probably spent a ton of money on at some point in our life. But what are you seeing from some of the trends for what a household or family is experiencing trying to pay their medical bills?
Yeah, actually, I ran across an interesting study from the point of view of a healthcare provider. So think doctor and hospital, and how we all know what plan designs have done over the years. And when I say plan design, think deductible, those types of things. But
yeah,
how are providers able to collect on their outstanding patient bills?
Yes.
And this study was by a company called Kodiak Solutions. They claim to work with about 1,850 hospitals and 250,000 physicians. So large study. They took a look at, how about the delinquencies and the collection rates on their patients in 2023? And they're finding an alarming trend. Patients aren't paying their bills even nearly what they were before. And I think before it wasn't great, but now it's even worse. And what's really interesting about it, they noted of all the delinquencies out there, 53% of them had insurance of some type. So it wasn't that they didn't have any coverage at all, even though the self-pay patients, meaning those without insurance, had the highest rates of delinquency. 53% had insurance. And they found that $500 was the break point. So if you owed a bill for over $500, good luck collecting it if you're a provider. Under that, higher chance. But I think they even talk about it. They expect about a fifth of the outstanding revenue to come from patients. And of that, only half are they collecting on half. So I know we're doing multipliers and divisions and all that good stuff. But, they talked about 1.1 billion in collectibles. They expect only to get 500,000 back from the patient side. So big numbers. We have providers as clients. We have employers that have employees struggling on the other end of that $500 bill. I get it. But anyhow, there's our topic for today.
I think it's a perfect time to plug the VIP network.
I like it.
Where
it's wise.
Seriously, this is why we created the network. Is there a way to direct a patient to a high quality provider who is willing to offer a discount on their services, make it transparent, and pass that savings on to the self-funded employer?
Yes.
And allow you to waive the cost share to the employee? Because let's be honest, it doesn't take much to hit $500. So I went to the orthopedic. So that first visit, right? So they're with you a little bit longer. My bill, I'm on an HSA, $458.
Yeah. That's after insurance discount.
Yes. Thank you, buyer. You're right. That's after the discount.
Yeah. Well, and what's scary is I've been on our health plan at the agency now for almost 8 years, and our deductible, I've been on the HSA, but I've gradually stayed on the similar plan, but it's almost 50% higher deductible because we keep offering the higher and higher deductible that's there. So you think you're out of pocket in 8 years is half as much. And we've seen that with other employers, that it's doubled. And granted, we're all responsible for that, right? We've advised our clients, you've got to raise your deductible to keep that increase down. Often that is typically our fully insured groups. But, if you're looking at self-funding, exactly, Chris, there are ways to waive the cost share for the patient so that they go to the right spot. It's good for everyone. The provider gets paid, the family saves money, the employer saves money. And now you're offering that family free healthcare or free prescriptions for doing something they needed to have done anyway.
Not every employer is ready for self-funded, but Brad, I'll put you on the spot. How many of your self-funded clients have you radically changed? I shouldn't even say radically, that you've had to increase the deductible and the plan design, and did it ever have a big impact on the self-funding budget?
I would say our self-funded clients that have gone from fully insured to self-funding often didn't have to change their plan at all. And it was really more so to gain greater control over their budget. Yeah. And often the switch helped them avoid doing a fully insured plan change. So you get kind of one-time savings and bump to do it. Well, and more than just 1 year, but there's especially a savings first year. I think after that, what I love about it is they can see the claim data, and you can make those decisions based on their actual usage so that they can see, wow, that's only going to save us 1%.
Yeah.
Or conversely, you might say there's some other levers we can do, VIP, that might save us more than that. And so, yeah, I do find though, when a group is self-funded, I know this is kind of going off on a rabbit hole, but we tend to make less drastic changes. I think
Yes.
because you're in total control as to what you want to do, and you have the data to make those decisions.
I think that's more fun too when we have our conversation with our clients, where you have HR who is patient member and family focused, employee focused, and you've got finance that is looking at the budget. You can accomplish both of those. You can provide a strong benefit plan that's affordable to the employees and still pick up savings as the employer. When we're fully insuring a client, sorry, this is the next plan design. That's the only way to pick up savings. And it's just not, you're going to sacrifice the family's experience for.
My microwave still works even after.
Anyway, thank you, Brad, for bringing this one up.
Brad.
Good topic.
All right, see you
Take
guys.
care. We'll see you. All right, bye-bye.